What is value investing? Value investing is an investment strategy where you look for shares that appear to be cheaper than their true worth. Instead of following the latest market trends, value investors focus on the fundamentals of a company, things like its assets, profits, and cash flow, to decide whether it's a bargain. In other words, they try to buy a great company at a good price. Value investing is different from growth investing, which focuses on companies expected to grow quickly rather than those that are currently undervalued. Why does it matter? Value investing matters because it encourages a disciplined approach to investing. Rather than chasing hype or short-term gains, it focuses on long-term wealth creation. For investors, this can bring both financial and emotional benefits. Financially, buying undervalued stocks can increase the potential for future gains, as the market eventually recognizes the company's true value. Emotionally, it helps investors act against popular sentiment and avoid panic selling during market swings, because decisions are grounded in fundamentals, not emotion. A key principle in value investing is the margin of safety. This means paying less than the estimated intrinsic value of a company, which reduces the risk if the market doesn't behave as expected. Here's a simple example. Imagine a company with assets worth £100 million and debts of £40 million. Its book value is £60 million. Suppose its shares are trading at a total market value of £50 million. A value investor might see this as an opportunity. The company appears undervalued because the market price is below its calculated worth. If the company performs well over time and the market recognizes its true value, the share price may rise, rewarding those who bought at the bargain. Many value investors also build a portfolio of multiple undervalued stocks to balance risk and reward, rather than relying on just one company. What else should you know? Value investing requires patience. It can take months or even years for a stock's price to reflect its true worth. Not every undervalued stock is a good investment. Sometimes a company is cheap for a reason, such as declining profits, management issues, or industry challenges. Famous value investors like Warren Buffett emphasize looking for companies with strong fundamentals, reliable earnings, and a competitive advantage. Value investing often involves metrics like the price-to-book ratio, price-to-earnings ratio, and dividend yield to judge whether a stock is reasonably priced. The approach also encourages sticking to a margin of safety and acting against short-term market trends, which can feel counterintuitive but reduces long-term risk. To sum it all up, value investing is about finding shares that are priced below their true worth and holding them patiently until the market catches up. It's a disciplined, long-term strategy that focuses on fundamentals rather than short-term trends. By emphasizing margin of safety and careful portfolio construction, value investing can help build wealth steadily while reducing emotional decision-making. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description. Don't miss out.